And welcome everybody. Thanks especially to the Boulder Bar Association. Laura and Kyle, I think, really did an exceptional service to our membership by so quickly putting together this series of free online CLEs for a lot of the issues that just sort of fell into all of our laps. So kudos to Laura and Kyle for their fast thinking, their very incisive thinking, and their excellent execution on getting this series put together. I'm assuming that many of you have attended some of these already. There's probably going to be overlap for this presentation and the presentations that were given by people this week and last week. The overall theme here is the three issues that our law firm has been encountering the most. We're a full service law firm except for criminal law, and these are the three main categories of issues that we've been seeing from our primary client base. I would hope that this could be an informal conversation with everybody involved, because I'm sure everybody else is experiencing similar things or viewing things in different lights. So if you have a question or a comment that comes up at any time, please type it into the chat, unmute yourself, interrupt me, whatever works. And I think we could talk about it and maybe turn this into more of a collaborative CLE presentation than just me running through the slides here and talking about the issues as I've been seeing them and as our law firm has been seeing them. But the three big categories that we've been dealing with are health insurance compliance, which has been sort of a sleeper issue that not a lot of people are talking about. Overall employment concerns, and risk management. Risk management branches off into two different directions. There's risk management from a client's perspective, but there's also a risk management from a law firm's perspective. So we're going to talk about both of those. The big issue for us is in health insurance. Health insurance is a complicated and nasty maze on its own. It only gets more complicated as we start talking about layoffs, terminations, furloughs, reductions in hours, things like that. So we're going to start there. And the big decision-making tree usually starts off with this question: what kind of insurance plan is either your law firm or your client looking at? The two primary types of plans are ERISA governed. ERISA is a federal statute that governs, originally it was supposed to govern large national plans, but it's been trickled down into even small businesses operating only on the local level. But is it an ERISA plan, or is it a typical insurance-backed, insurance-funded plan? Most of the time, if it's an ERISA plan, the client knows about it. ERISA plans very traditionally have a self-funded component to it, meaning that your client has already deposited a substantial sum of money into an account. Your client usually has hired an outside agency to come in and administer the plan. Sometimes the administrator is someone as big and common and insurance looking as Blue Cross Blue Shield. Sometimes they go with a private plan administrator. But usually the client knows they have an ERISA plan because usually the client has deposited a large sum of money in the plan's account to fund the plan. Most commonly, and for, I would imagine, most of the businesses operating in Boulder County, the health insurance plan is a traditional insurance-based plan where the insurance pool makes a series of offerings to the employer selects the type of plan. Sometimes the employees have some say in whether it's going to be an HMO, PPO, or a privately funded high deductible plan. But for the most part, most of our clients are going to be looking at the insurance plan. The reason that this is an important issue for us to be looking at during the COVID issue is because right now it seems like every employer is facing the question of, do I lay people off? If I do lay people off, can I continue their health insurance coverage? How do I continue the health insurance coverage, and how do I get the employees back? And that question is going to be determined by what type of insurance policy it is and what kind of control the employer has. If it's traditional insurance, the employer often has little to no control. If it's an ERISA plan, the employer can have a great amount of control over eligibility determinations because for the most part, it is the employer's money that's self-funding and paying for claims. But there's a few catches there that can really trip up companies. So the first step and the most important step is get a copy of the policy, review the policy. When you're looking at the traditional insurance plan, the provision that everybody needs to be looking out for is the minimum number of hours worked to be eligible for the insurance plan. Usually it's a 32-hour-a-week requirement. Sometimes it can go below that. For restaurants, sometimes there's a lot of flexibility. Sometimes they have very different or unusual plans, but most of the time when you're getting a traditional insurance plan document for review, there's going to be a minimum hours worked per week requirement for the employee to be considered a full-time employee and for the employee to be eligible for coverage under the employer provided plan. Most of the time, the agent or broker of the insurance policy will know about that language, but from a client's perspective, because they're about to make representations to their employees about what kind of coverage they have in place, how long that coverage can stay in place, things like COBRA, the best thing to do is to first talk to the agent or broker, but ultimately get a copy of the health insurance plan from the insurer directly. Sometimes those requests are processed very slowly. That can be very frustrating when you say, give me a copy of the plan, agent says we've sent it up the line. It's going to be 6 to 8 weeks before you get an official copy. That's not entirely uncommon. If it's going to be a delay of that much, ask the insurance copy or carrier for a representative copy of the insurance policy or an exemplar copy of the insurance policy, something that isn't necessarily binding on them formally, something that they didn't have an officer of the company sign off on specifically to warrant that, yes, this is a copy of the policy that you've purchased, but something that can at least get the employer's review started. Because I've never actually seen a case where the demonstrative policy didn't ultimately match the official certified policy. It's possible, but it's a step to save some time and reduce risk. The big issue that employers are seeing is a reduction in hours can inadvertently terminate coverage. Sometimes this might not matter. If somebody dips down to 31 hours in a week and inadvertently loses eligibility, as a practical matter, that might not even cause suspicion on the health insurer's part. There might not be a question asked, they might still provide it. However, the problem comes when somebody has an unexpectedly large claim for health insurance benefits, something that usually goes into the maximum insurable limit. Think about long-term catastrophic type diagnoses or treatments, some of the more horrific stuff. In that case, sometimes you'll see the insurers actually treat it as an underwriting event where they go back, they review the policy, they ask the employer for confirmation of hours worked for each hour that might matter. And if you see that dip in hours to 31 hours or 30 hours, whatever falls below the limit on the insurance plan's minimum enrollment requirement, you might find yourself, well, not you, but the client might find themselves in a very difficult situation where the insurer denies coverage, saying that the employee didn't meet minimum eligibility requirements. And all of a sudden there's a 6-figure hospital bill where everybody is scratching their heads wondering who pays it. And the employee looks to the employer and says, what are you talking about? You agreed to provide this. I paid the premium. I want coverage for it. So the big thing is, before people start going into layoffs or reductions in hours, to understand how the health insurance plan interacts with each employee's minimum eligibility requirement. ERISA plans are a little bit different. There are ERISA specialists out there that deal not just in ERISA governed health insurance plans, but in ERISA governed retirement policies, retirement funding, things like that. I'm not going to go into that level of detail. But if you have a client who has an ERISA governed health insurance plan, it's really necessary to find that out as soon as you start talking about strategic plans for reductions in hours, layoffs, or terminations. The reason for it is that under an ERISA plan, many employers have actually deposited or guaranteed large sums of money to be available to cover whatever insurance needs there are. It's basically a self-funded insurance plan with some limitations on that. That means that an employer pays the premium, an employee provides a contribution for the premium, the employee or a dependent goes to the doctor's bill goes to the plan's administrator, which is usually a third party. The third party says, great, we're writing a check out of the funding pool that exists for this ERISA governed plan. No insurance carrier really cares about that. So frequently, eligibility determination under the ERISA health insurance plan documents is deferred to the employer itself, where there's a provision that says, employer, you get to determine who is eligible for enrollment and what those terms are. In other words, no 32-hour minimum hourly requirement. Seems like a really easy scenario for the employer to say to employees, okay, we're going to lay people off or we're going to reduce their hours to below this 32-hour threshold. But we're going to allow you to continue to be a plan participant. You're going to stay under your health insurance. The employer is going to continue to make their premium payments. The employee, if they have an employee contribution, as long as they make that contribution at the time that the premium is due, their coverage is going to continue even if they're not working at all, or even if their work level goes down. It's a really great, really flexible, possibly expensive gesture by the employer to expand that kind of coverage determination. Almost every time that the employer goes to the plan administrator and says, hey, we're going to redefine what it means to be an employee, the plan administrator says, yeah, no problem. You get to make that determination. We defer to you, so do whatever you want. The problem is there is almost always a catch, and it's a very substantial catch. The catch is that most self-funded ERISA health insurance plans have what's called a stop-loss insurance policy on top of it. And that is exactly what the name says it is. It's an insurance policy that limits the employer's exposure and the employer's spend under that self-funded insurance pool. So it's basically for the first, pick whatever amount you want to say, for the first $1 million that's in the employer provided pool of money, the employer pays. But if in the course of a policy year, there's more than $1 million or whatever that limit is in claims for health insurance benefits that get paid, the insurance policy, the stop-loss policy, will kick in and pay for whatever would be covered above and beyond that. The good thing is you don't often see stop-loss policies kick into effect. The bad thing is that the stop-loss policy usually says, we're issuing this based on the insurance plan as it existed at the time it was adopted. And usually the employer has a minimum hour requirement that says an employee is only eligible for insurance coverage if they meet these minimum requirements. So even though the plan administrator is saying, make whatever changes you want, that stop-loss policy is based only on what was in effect at the start of the stop-loss policy term. And the stop-loss policy usually has a provision that says if you're going to make any changes to the insurance plan, you need to submit it to the stop-loss policy carrier for approval before that change can take effect. So what we're seeing here is a very good-natured employer who says, we're looking at 2 months of layoffs here. We're expecting to bounce back from this. So what we're going to do is, since it's an ERISA plan and we get to call the shots, we're going to expand the definition of an employee to include everybody that we're laying off so that their insurance can continue for a few months during this furlough period, and they're not going to have an interruption in coverage when they get back. The problem is the stop-loss plan might not actually allow them to do that. So everybody needs to get a copy of the stop-loss plan. Everybody needs to review the plan documents that the employer already has, usually, or that the plan administrator should maintain a copy of, and look at both and see how an employee is defined. I bet you most clients have a definition of an employee that's very traditional, like minimum hours of 32 hours a week. Most of them have that. And the reason that they have that is because the plan administrator usually helps the employer draft the plan language to begin with. They use stock language, and the stock language usually includes that 32-hour minimum requirement. So if that's true, the employer, before they offer and make a promise to their employees that the coverage is going to continue, they need to first draft a proposed change to their insurance plan and send it to the stop-loss policy carrier for their review. The really frustrating part is that the stop-loss carrier almost always says, "What are you talking about?" And they say, "It's your plan, it's your money, you make the determination of what an employee is." And at that point, the employer needs to come back and say, "No, under this policy provision of the stop-loss policy, any changes that we make to our plan," which would usually include the changes to the definition of an employee for minimum hour requirements, need to go up the line and be approved by you in writing. So you need to be proactive. You need to demand that they send it to legal and that they actually review the change of your definition as an employee under the original policy. So to recap, 2 different categories of insurance policies. Traditional insurance plan is very straightforward, but there's usually an unmodifiable minimum employee definition that if an employee goes below full-time status as defined by the insurance policy, they're no longer eligible. So people, employers, need to be very careful about that and make sure that if it's an insurance policy, they know what the minimum enrollment requirement is, and that they're making very deliberate decisions and very deliberate representations to the employees that are affected by reductions in hours or layoffs about what that means for their health insurance coverage. Then on the ERISA side, first you need to make sure it's an ERISA plan, but the employer usually knows that. Second, you need to check and confirm that it's a self-funded ERISA plan, but the employer usually knows that too. Third, you need to check your stop-loss policy for what requirements you need to follow before you can make any changes in the underlying plan document. Even if your plan administrator is saying, "Nah, go ahead and make whatever changes you want," you almost always need to run that up the line for your stop-loss carrier for it to work. During COVID, a lot of the large carriers have, probably in recognition of these issues, and especially on the ERISA side, they've just automatically extended coverage to May 31st. The 2 carriers that we've seen be very aggressive in promoting this are Cigna and Humana. I don't know about Blue Cross Blue Shield, but it's probably very easy to find. Those are 3 of the 5 biggest health insurance carriers in Colorado. So they just said, no matter what is happening, everybody stays an eligible employee irrespective of hours worked until May 31st. So they basically waived the minimum hourly requirement. However, May 31st is pretty quickly approaching, and it looks like there are going to be long-term ripple effects that go far beyond May 31st. So whatever is in place for employees on May 31st, they may have been covered up to that date, even if they're working 20 hours a week or less. However, as soon as that date comes, unless you get a bulletin from the insurance carrier saying we're going to continue to extend this indefinitely, employers need to be very careful about making sure that employees know whether they have coverage in place after May 31st. There's obvious liability issues here. The biggest one is if on June 1st, somebody goes to work, their hours have been reduced to 29 hours a week under a traditional insurance plan. Out of their paycheck is an automatic deduction for health insurance premiums for the month of June. The employer pays a premium, the employee pays a premium. Everybody thinks there is coverage, but if, for example, Cigna pulled this basically gratuitous gift of extended coverage to May 31st, as of June 1st, that employee might not be covered. And that employee might go straight back to the employer saying, hey, you owe me this, you promised this, you provided this. And that is a very bad time to find out that the health insurance coverage is involving many hundreds of dollars a month in benefit payments for that employee, that employee's family. If there is a termination in coverage, employees have COBRA. COBRA is a very easy but terribly expensive resource that they all have. The important thing from an employer's perspective is going in and informing the employee about whether they have coverage on June 1st if the gratuitous coverage is not extended by the carriers, what that coverage is, if coverage has been terminated because they no longer meet minimum requirements, that there is the right of COBRA to cover that period. Otherwise, we're looking at a no health insurance situation. Looking down the road, I think this is something that's going to catch a lot of employers off guard. I think that I think it's the IRS Form 1095 that guarantees insurance coverage and certifies insurance coverage for employees under Obamacare. I think at the end of the year, a lot of employees are going to get their 1095s and find out that there was actually a gap in coverage that they didn't know about. And when that happens, I think there's going to be a lot of confusion about what's going on, why wasn't this provided, is there a harm at all? But I think people are going to be caught very off guard by that in January of 2021 when you start seeing those 1095 forms getting mailed out to the employees. Looking at employment-based concerns, so changing gears a little bit. Actually, let me pause there. Anybody have any questions about the health insurance coverage issues? Not seeing anything pop up on chat, but if you've got any questions, post it to the chat and I'm happy to go back to them and talk about what our experience has been with this in the past couple of months. Going ahead to employment concerns. A lot of questions that we're getting are, what are my obligations to employees? The basic, and this is very basic, most employees in Colorado are at-will employees. If there's no employment contract, they're presumed at-will employees, so you can fire and hire as you wish. However, a lot of employers provide an employment contract on top of at-will status, and the employment contract makes promises that would be on top of the at-will requirement. So a typical contract provision will be, you're an at-will employee, we can fire you or hire you at notice. But if you're going to get terminated, we're going to offer you 10 days notice, and we're going to in turn expect 10 days notice from you. Employers need to be careful about what those contracts are. Sometimes the employer will say things like, I don't have a contract, but then you go and look at the offer letter after the fact, and the offer letter really is a contract that makes promises above and beyond at-will status. From a law office perspective, I think we need to be asking all of our employer clients to see what their policy is or see the offer letters that they typically send out, just to be able to confirm that the employees truly are at will and see what kind of promises are being made to employees that might have lasting impacts if there needs to be a reduction in hours or a termination. But if it's truly the very basic scenario, at-will employee, somebody can come in and say, I quit, no notice. Somebody can come in and say, you're fired, no notice. I'm thinking of a lot of labor-based practices. That's truly a terminate at will or a hire at will situation. This is another very basic point, but if an employee is terminated, final paycheck needs to be issued within 24 hours of termination, and it needs to include all accrued PTO. There's always questions about what accrued PTO is, and that's only gotten more confusing now. We're seeing questions from clients along the lines of, as soon as coronavirus hit, we just sent an email out company-wide saying we're going to offer PTO so many days for anybody who gets sick or feels sick. So don't worry, you're going to get paid. If you're not feeling great, don't come to work. Great email, but that may cause complications if there's a claim under the Wage Claim Act later. My view is be conservative. It's going to probably cost an employer far less if they need to lay off an employee to pay them for 2 extra days or whatever that informal email granted to somebody than it would be to have to deal with lawyers and deal with a Wage Claim Act situation later. Sometimes you're going to see people who say, I really don't want to do that. I don't think I have to. That's something that I think is going to require a fair amount of research into what exactly the employer promised and whether that fits within the definition of accruable benefits that need to be paid within 24 hours of termination. But at least in the past 5 weeks, and probably as layoffs and reductions in hours become a more regular occurrence in the next 4 to 6 months, I think employers are going to need to be very careful about what they are representing to their employees about paid time off. I think as we see people coming back to work in the coming weeks, there's going to be an increase in the attention paid to, if you're sick, stay home. People are really going to mean it. And I think employers are going to be making offers to their employees that actually require payment upon termination, even if they didn't intend it to be so. So bottom line, if somebody's getting terminated, issue the final paycheck within 24 hours of termination, put all paid time off in that final paycheck. And if you have any doubt, if the employer has any doubts about whether a benefit that they offered constitutes paid time off, probably the safest bet is to pay it, unless they can't. And if they can't, that's when it becomes a very fact-specific inquiry where I think they need to have an attorney take a close look at exactly what they promised and exactly how that fits under the Wage Claim Act. Complicating this, Colorado enacted the HELP Act, 7 CCR 1103-10. And this was enacted on, I believe it was March 11th. And it requires employers in certain industries to provide up to 4 days of paid sick leave. And the industries here are very specific: hospitality, food service, childcare, education, including education, transportation, and then healthcare. Home healthcare, I believe, is included, but it's important to check on that one. This was something that the Colorado legislature passed very quickly. It stays in effect for as long as the governor's state of emergency remains in effect. And it says that for the people in that very narrow category of specifically defined jobs, they straight up get 4 days of paid sick leave if they are experiencing symptoms of coronavirus or COVID-19. What does this mean for a termination? And if you've got a food service worker who's continuing to go to work during this time and all of a sudden says, I've just been laid off, give me my final paycheck and I want my 4 days of PTO under the HELP Act, that's a great question. During the first few weeks that this took effect, our advice to clients was on a very practical level, which is if somebody, know this is a risk. If you have the ability, be conservative and pay it, because it's going to be far cheaper for 1 to 10 employees than it would be if you're going to be dealing with a wage claim situation later, or having the threat of a demand letter that says you owe me this, pay me this now within a very specific period of time, or I'm going to bring my wage claim act and you're going to pay my attorney's fees. Looking forward, I think this is something where unless you know you're under the HELP Act, I think employers are going to need to take a close look at this on termination to find out what's the best course of action. Two things under federal law that everybody should be keeping in mind. Number one is the WARN Act. WARN Act says well, first off, WARN Act is typically for very large employers, not just big employers, but very large employers who have a lot of employees. Most of the employers who would be subject to the WARN Act would have in-house counsel, most of them. Some of them don't, but know it's out there. Know that if you're looking at an employer that has 80 plus employees, you need to pull the WARN Act and make sure that if there's going to be a mass layoff, that they're not subject to posting the notice as required under WARN. There's a link here to the Department of Labor's employer guide. I'm going to email these slides to Kyle. Kyle's going to send them out to everybody who participated. That's a pretty good guide published by the Department of Labor on what employers qualify, what employers don't qualify, and what needs to be done if there's going to be a layoff at a WARN governed employer. The second part that I'll only mention briefly is the Families First Coronavirus Response Act. This is the sick leave and extended sick leave that applies under federal law. This is something that I believe Jennifer Lorenz covered in great detail in her CLE earlier this week. Those slides and that presentation is available. Email Kyle at the Boulder County Bar Association and he can help you with getting that material. But included in these slides are, number one, a link to the employer guide, and number two, a link to the employer poster that is supposed to be posted at the premises next to all of the other minimum wage, unemployment, things like that. So two good resources there, plus the Jennifer Lorenz presentation that she gave earlier this week. That goes through a lot of the details that I don't think we need to cover here, but know that that's out there, and that if an employee says, I need to take extended sick leave, you've got to be looking for compliance issues under this and continuing to pay, even if there's going to be a furlough. Now, the furlough might truncate and might have an impact on their FFCRA enrollment, but it's all in the employer guide. Check it out there. The big thing that we're looking at for our clients for the long term is risk management. That's something that a lot of employers are not particularly concerned about or that is in the forefront of their mind, but I think this is something that could really come back to bite them 6 months from now as this continues to shake out. First, biggest employer question that they're getting from employees: if there's a reduction in hours, a reduction in pay, or a termination / layoff / furlough, the employees always ask, can I get unemployment benefits? And the really difficult situation is the employer wants to say, yes, of course you get unemployment. That's what's in place. We've been paying these premiums to help you. But you don't want people to be relying on those promises and coming back later to say, hey, you screwed me over. I didn't have that benefit available to me, or it wasn't as good as you told me it was. So an employer needs to be very specific in what they're telling employees. They need to say, you are eligible to apply for unemployment benefits. Pretty small point, but it's an important distinction because the unemployment determination is difficult, it's convoluted. Even as I've gone in and tried to figure out what unemployment benefits might be for a given employee who a client is about to terminate, you can't always get a very straight answer on it. So if the employee thinks, okay, I'm going to get this much per week, but then they find out that their application is either rejected or it's not as much as they were expecting, or they're making an application for the new, we'll call it emergency unemployment for gig economy workers, like an Uber driver, and they find out that this isn't what they were hoping for at all, it's very difficult for the employer to say, well, I guess we were wrong. the wrong employee might come back and say, you made a promise to me, you didn't deliver on that promise, and I'm mad enough to be calling a lawyer about it. The other, I think the biggest liability that employers are facing is on the representations they make about continuing health insurance coverage. What employees need to know when they're terminated or when their hours are reduced to the point where they might not be covered, they need to know that they have a right to COBRA. That's the big one. That's what an employer needs to be maintaining compliance with. But especially in Boulder County, especially in Colorado, we see a lot of very good-natured employers who are trying to do everything they can to keep their employees healthy, to keep them on health insurance, so that when things kick back up again, hopefully in the very near future, everybody's healthy, everybody's able to return to work, and we can get back to normal more quickly. With that, employers are over-promising. They're making promises about, well, we're going to change the definition under our ERISA plan. And that change in the definition is something that we're just unilaterally doing. We were told that we can do it by our plan administrator, so you are covered through. And so some of the employers want to make the promises very long-term. It's theoretically possible that employers could say, we're just going to keep you on this for as long as you're furloughed. Cosmo Kramer was furloughed from the bagel company in Seinfeld for about a decade. So an employer needs to be very careful about not telling a furloughed employee that they're going to be on health insurance paid for by the employer indefinitely. The language is very basic language. We are trying to get permission from our, for example, stop-loss plan. And if we can get permission, we will let you know how we can change the definition of an employee and for what time period. I would caution any employer on making promises about continuing health insurance coverage beyond May 31st, because that's the only confirmed date that we've seen from most insurance carriers that they're willing to gratuitously extend that coverage. So bottom line, if an employer is trying to keep people on health insurance, the easiest way to do it is to keep the employee eligible under the existing plan. And if the employer is trying to do something charitable, something beneficial, the employer needs to qualify that charitable intent by putting it in the present statement of intent category from week one of law school, as opposed to the we are promising you this benefit and you should rely on this benefit category. A lot of employers are getting questions from employees about the Families First Coronavirus Response Act. If I invoke sick leave, what am I going to be paid? For how long am I going to be paid that? And for how long can I stay on that? Do not advise them on it. It's a complicated calculation. It depends on the employee's eligibility for it, and it depends on whether the employee even qualifies for it. There's two different categories. The second category has all of these subcategories. Employers cannot be running FFCRA calculations for them. The best thing to do is to direct the employee to the Department of Labor's FFCRE employer guide. And I believe that a link is accessible from the link on the previous slide, but the Department of Labor has guidance specifically for employees. And all an employer should be doing is saying, look there, here's a guide. And if you need advice, get advice from your own attorney. Other big ones, don't promise that they're going to get their job back. That could mean a lot of different things. An employee might think that they have one job when in reality they're still categorized under a different position. Don't promise that their health insurance is going to continue, and take the last paycheck very seriously. If you terminate someone, issue a final paycheck within 24 hours. And if you have any doubt about what paid benefits need to be included in that final paycheck, do more, not less. If you think you made a representation about giving everybody sick leave for coronavirus, err on the side of caution. And if an employer has any doubt, they got to talk to their lawyers and go into a more factually intensive analysis of whether they need to be paying even more to terminated employees to prevent a Wage Claim Act lawsuit at a later time. A lot of clients are asking about, do I pay the mortgage and do I pay the lease? The big answer is, yeah, you pay it. Too many even sophisticated clients right now are asking if they have to pay the mortgage and if they have to pay the lease. A lot of people are afraid that they are being stupid if they pay a mortgage or pay a lease. The reality is, if you qualify for any of the mortgage programs, and for the most part, that's going to be an individual who might qualify for mortgage forbearance. Even if you qualify for forbearance, it doesn't forgive the debt. So the damages are still growing. So for any employer, for any business, for any individual who wants to just take a month off of the mortgage or the lease payment, they really need to understand, and it's difficult for some of them to understand this, that they're going to owe that money eventually, and probably with interest, unless they qualify under some very specific qualifications. Chances are, if it's an attorney-client relationship that's strong enough that the client just calls and says, you're my lawyer, you've always been my lawyer, you help me with these things, I'm not paying the mortgage, am I an idiot for doing that? Probably that person has qualification issues based on employment status, eligibility, financial hardship, all of that. So don't take the risk of just letting a pile of damages grow against you and needing to pay 3 months of a lease or a mortgage payment down the road. For lawyers, these are the all-important malpractice risk issues that I think we all need to be looking out for. First, this was especially true when the Families First Coronavirus Relief Act came out. It was really difficult to get any guidance. There was no federal guidance on that. And it looked like a really bad choose your own adventure of which category is the employee invoking for what business and what do they qualify for. One has 10 weeks, one has 2 weeks. Does that mean it's 12 weeks total, or does the 10 weeks encapsulate the 2 weeks provided before? Until the Department of Labor ended up publishing its guidance about 2 weeks after the fact, it was really important to go through and qualify the answers that we were giving to clients. And I think it actually is still important. If somebody does a first read of the Department of Labor guidance under the FFCRA, your first read, at least mine was confusing. Even though I'd been going through it for 2 weeks already, the first time that I read the federal guidance, I thought, I think I understand that. So continue to be cautious and continue to qualify your answers, and know that interpretations in Department of Labor guidance could very quickly be changing. For a while, it felt like for about a week, in the second week that it was enacted, it felt to me like it was changing just about every day. The second category is applying for federal money. Everybody was using the phrase free money, looking at the PPP program, which I believe was also in Jennifer Lorenz's program, but I could be wrong about that. Clients were calling, everybody was interested. How do I get the free money that gets forgiven 85% at the end of this? I want my free federal money. As tempting as it is to use the phrase free money, I think that clients will probably want to sue you over that phrase. So be very careful about representations about it. Headline, I believe yesterday, was that all of the SBA money has run out. I wouldn't be surprised if we see another injection of capital from the Fed. So it may come back up again, and be very careful, because anytime a business is applying for an SBA loan, even if it feels like there's a free money component to it, the loan document almost always says, this is a loan and you have to pay it all back with interest. In the case of the payroll protection money, if you wanted to qualify for the forgiveness, you needed to apply for it, go through the vetting process, and all of that was later. So the idea that even that money was free, forgivable, and a charitable benefit from the federal government, not for everybody, always with qualifications, always with strings attached. Another category, we got a lot of questions. Can you run unemployment benefit calculations for us so we can tell employees what they're going to get? To me, that was a run for the hills kind of question. I think it is critical to not be running unemployment benefit calculations for employees. Similar to that, when there's a reduction in hours or a reduction in wages being considered by an employer, everybody wants to run the numbers and see if an employee either has a reduction in hours or a reduction in pay. Where's the sweet spot where the employee is better by getting some unemployment benefits that they can maximize while still getting some money from the employer? Everybody's looking to find this, perfect formula where the employer can reduce hours or reduce pay relatively substantially. The employee can get an unemployment check and they can maximize the two to avoid a scenario where the employer is paying, but it actually reduces the amount of net money going to the employee. That's, to me, another run for the hills kind of question, because the unemployment calculation is pretty detailed. There are qualification and eligibility issues that you never quite know about. I've been running away from those questions and trying to tell the employers that they need to make a decision based on what they pay. And if they're trying to play, I hate to use the term a game, but if they're trying to play a game where they can maximize their reduction in hours and reduction in wages, while at the same time maximizing the employee's net financial result by unemployment, I think that just sets everybody up for frustration. I think it sets employees up to be really mad at the employer by saying, no, it didn't work out the way we thought it was going to work out. I've got more money this way. Why should I work the extra hour? I think that's a negative scenario all around. Other malpractice risk areas for lawyers, remote notarization. Everybody's talking about that one. I like to grouse about, outside of the context of wills and trusts, but for just a basic affidavit, what does a notary really provide? Grousing aside, remote notarizations are technical, they're precise, they require a fair amount of jumping through hoops. Kurt Hofgaard, yesterday or the day before, gave an excellent presentation from an estate planning perspective about what you need to do to have valid remote notarizations. Get that presentation from the Boulder County Bar Association's website. It's very good. It's going to give you a CLE credit. Pay close attention to that, because a remote notarization is not nearly as easy as I had wished it would be. Another malpractice avoidance issue, just take a quick look at what your malpractice policy says. Take a look at what it says about helping people with wills and trusts. If you're not a wills and trusts practitioner, you might have family members or friends saying, hey, can you do a quick will for me right now with everything that's going on? Check to make sure that that's not excluded from coverage. Check to make sure that you understand the provisions in your malpractice policy about informal advice, about retention letter requirements, and about the phone consultation with potential clients, and whether that's covered or not, or what you need to do to even be able to advise somebody over the phone. That's something that we should probably be doing once a year anyway, but now especially, especially as we're being asked to advise clients on new issues in a changing world, go back and take a look at it. Finally, business advice versus legal advice. I had a client call wanting to know information about getting the free SBA money and some grants, and I offered a very lawyerly answer of what I was talking about before. You need to know that this is a loan. You need to know that there's going to be specific requirements for you to qualify for the forgiveness program. I wouldn't go into this thinking that this is free money at all. Don't do that. And they say, yeah, I hear you, but what would you do if you were me? To me, that's always I always have the malpractice light bulb going off in the back of my head, and I think it's a good place to jump in and say, it doesn't matter what I would do. Here's the best legal advice I can give you. And to continue, even in this very odd time, to go back to the good advice, which is if you want the loan, get the loan documents, email them to me. We'll both go through them and we will tell you what we think it means. We will tell you what we think you need to do to qualify for certain federal programs, and we will advise you legally on it. That's the best advice. So that's all I've got. Questions, concerns, boredom, easy lunchtime CLE, anything. Feel free to unmute yourself. Okay, well, with that, we will conclude today's lunchtime CLE. I thank everybody for attending. I wish you all good health and safety for you and your families, and have a nice weekend.
Excellent. Thank you again, Jeff, for agreeing to present, and thank you everyone for joining us today. This recording will be on the website with all the rest of this series. This one will be up probably later tonight or tomorrow morning at the earliest. YouTube's being a little slow. But again, thank you for joining us and stay safe. Have a good weekend. Bye.